Thanks very much. Howard Marks is one of the world's foremost credit investors. With a track record like yours, Howard, you have to be something of a student of the credit markets, which you are.
Yes.
And if you're a student, you have to be making observations all the time. I want to ask you your observations about one of the most noteworthy developments in credit as of late, a gigantic, massive, if you like, $1.8 billion loan that Apollo, a firm that you compete with now and then, is making to finance the purchase of the newspaper company Gannett.
Yes.
This is a loan that once upon a time, in fact not so long ago, you could only get from a bank.
Right.
Now you can get it from an asset manager. What does that say?
Right. And the bank would syndicate it. They wouldn't lend their own money. They'd scoop it up from others. Well, it says that there's a lot of money that can be collected by alternative investment management firms like Apollo and Oaktree and the ilk. I mean, pension funds can't make the returns they want in stocks and bonds. They accept that. And so they're looking to alternatives, and money is flowing into alternative firms. And obviously Apollo was able to compete and win the ability to lend $1.8 billion for that merger.
Now, when you say win, I'm assuming that it's because Apollo was willing to lend at a lower interest rate than everybody else.
I assume that it was competitive, and that's how you win the auction, by being willing to accept less return, ostensibly less safety, but you know, I presume they know what they're doing. They're pretty smart guys over there.
Is a loan of that size to an industry like newspapers something that a firm like Oaktree would have the capacity or the appetite for?
Well, we're not, number one, we don't concentrate our investments to that extent, so I can't imagine we would ever lend $1.8 billion on anything if they're retaining the whole loan. You know, we do funds that are $1.8 billion, and we obviously diversify them. So we don't have that size or that appetite for concentration. I don't know the credit well enough to know how good a loan it was.
It certainly comes at a fetching interest rate.
Well, if you look at the interest rate, which was 11.5% in an environment in which the 10-year Treasury pays 1.75, you have to assume that there was a lot of risk there. And by the way, remember what we said before. Apollo bid in terms of interest rate was low, I assume, compared to the competition. Other people might have wanted 12 or 13. So it tells you that it's a risky loan.
Do you think the point here is just to clip a handsome coupon? Or is it to do what Apollo, and for that matter, Oaktree have done in the past, which is effectively loan to own?
I don't know what's on their minds. You don't make new par loans. You don't make loans at 100 cents on the dollar to own, because then if you win, you ended up paying a very full price. What we call distress for control, what distress for control investors try to do is buy debt at a discount so that they get in at a bargain price. So I'd be surprised to learn that it's loan to own, but depending on how risky the proposition is, I'm sure that not getting paid and instead ending up as an owner must factor into the picture.
I'm glad you raised distress because Oaktree, is in the process of investing, right, one of its newest funds,
yes,
which is one of the largest to date, your newest distress fund, and I think you've allocated some $1.5 billion of new money out of that fund in the course of the first couple of quarters of this year. How would you evaluate the distress market right now?
First of all, you say new funds. It's a new fund, but it's 4 years old. We raised it in 2015 on a standby basis. We raised a fund for current investing, and then this on reserve. We invested the current investing fund. Now we're hitting the reserve fund. And the fact that we're roughly 30% invested after this time shows you that the going is slow in distress. First of all, the economy's too good. Not many companies are getting into trouble. Secondly, the capital markets are very generous. So if a company needs rescue finance, they can get it, or refinancing to push off their maturities into the future. So this is not the kind of climate in which good, healthy companies with healthy businesses get into distress. There is some distress in areas like retail and energy, but these are industries with, let's say, their ups and downs.
Well, Oaktree has historically had its greatest successes at times when the economy is not doing so well.
Sure.
And it brings to mind your latest memo, on the other hand.
Yes.
And I want to quote directly from it, Howard, because in it you say, and I want to point out that you've dedicated quite a bit of time to macro thinking and Fed policy, if you will, in your last two memos. In this one you say, should we be happy to see the Fed trying to prolong the economic expansion in the bull market when they're already the longest in history? Should it try to produce perpetual prosperity and permanently ward off a correction? Are there risks in its trying to do so? It all depends on which hand is doing the weighing. That's a somewhat cryptic, to me, way of questioning,
well,
at the very least, what the Fed did at its most recent meeting, Howard.
I'm never convinced enough that I'm right to be assertive. I mostly raise questions. But, it is unusual. I mean, usually what happens, we stimulate the economy when it's doing poorly, and we want to wake it up from the doldrums. We generally don't stimulate the economy when after 10 good years. We usually accept that there will be an ebb and flow to the cycle, and that that there might be a justified recession. We have the lowest unemployment rate in 50 years. And you usually don't stimulate at that time. So the point is that the Fed can stimulate. Should it do so? Is it the Fed's job properly to?
I get the feeling.
No,
you don't think it should.
I don't think it should. I don't think that. I don't think the Fed's job is to make sure there's never a recession. What the Fed chair tends to say, and Jay Powell said it last month, and I have a quote in there from September 2007, where they said, we're going to do what it takes to keep the expansion going. Is it the Fed's job to keep the expansion going forever? And I don't think so. If I ran the Fed, and I'm not applying for the job, what I would do is when the economy is roaring, I would try to cool it off so there's not too much inflation. When it's really weak and not creating jobs, I would encourage it and stimulate it. But in between, I'd leave it alone.
If the Fed keeps cutting rates, and that's what the market says it's going to do, Howard, what does that mean for investors? When, as you point out, the 10 years at 175,
yeah.
High-grade bonds are paying 3%, high yield is something in the order of 6%?
Yeah. It means that savers and lenders and people with money are going to have trouble getting good returns. All the returns emanate from the base rate, which is basically what the Fed sets. And the lower it is, the lower the prospective return on everything is. Now, the process of lowering the rates, it causes assets to inflate. So there will be more wealth piled up by the people who have assets, and it'll be harder for people who just have a little bit of savings to get a return.